The domestic cues. Just before that, I want to see what the Nifty implied open is settling in at. We'll just come up for you at the bottom of your screens. But yes, all eyes will also be on the RBI today. The big question is, will the June monetary policy bring a third consecutive rate cut or not? Remember, both in the months of Feb as well as April, you've seen the RBI cut rates by about almost 25 basis points. So will it be another 25 again? Because most analysts on the street are pricing in another 25 after today's outcome too. But who better than Sonal Varma, Managing Director and Chief Economist at Nomura, joining in today to talk about exactly that. Sonal, hi, good morning. Good to have you on the show. What's it going to be, Sonal, today? 25 bips, or do you think in one go they could perhaps cut down to 50?
Well, we think it is likely to be a 25 basis point cut. I mean, the MPC has delivered 50 already. So I think steady as it goes would be a better outcome today.
Right. Hi, Sonal. Good morning. This is Shrishti also joining in. But other than the rate cut, the street is also looking for the commentary and some changes maybe in the projections when it comes to inflation. Give us some sense. What are you penciling in, given the fact that the GDP data so far isn't that disappointing, and the recent print was also better than what the street was penciling in?
Yeah, absolutely. So if we sort of look at what has happened in the last 2 months, the growth numbers have come in, I would say, in line with the RBI's expectations, although better than street expectations. Whereas we've seen a bigger than expected drop in food prices. So incorporating both those trends, our view is the RBI is likely to retain its FY26 GDP growth projection of 6.5%, whereas the CPI inflation projection, which they currently have at 4% in FY26, that we think should get revised down a lot more. Our own expectation of the RBI's forecast is about 50 basis point downward revision to around 3.5%. So FY26 being a year where inflation undershoots the 4% target should be the message.
And if you talk about your GDP forecast for FY26, you've hiked that from 5.8 to 6.2. Now, recently we've seen very robust set of IIP numbers coming in much ahead of street expectations. Overall, FY24, FY25 GDP data has also been a beat versus street estimates. Where do you see the overall economy headed? Because this year we're also expecting good monsoon. So do you believe that our macroeconomics look rather stable right now?
Yeah, I do think India's macros look quite stable in the context of, relatively our growth is resilient. We have low inflation, fiscal current account deficits are well managed. So I do think macros are quite stable. Our own projection for FY26 GDP growth is 6.2%. So we do think FY26 will be a softer year than FY25, where we ended at 6.5%. And a few reasons for that. We are seeing, I would say, both positives and negative factors at play. The positives clearly being, as you mentioned, good monsoons supporting rural consumption. India is seeing some benefit from trade diversion. Oil prices are low. Inflation is low. These are clearly the positives. On the other side, though, we are also seeing a moderation in consumer credit growth, urban salary growth, which we think will impinge on urban consumption. The private capex side still remains very soft for a variety of reasons. And across Asia, what we've seen is exports are holding up partly because there's been a lot of front loading of demand ahead of tariff. So there will be some payback effect later on in the year. And we do expect global trade to slow down. So when we put all of those together, I think for India, there are positives and negatives. On the whole, we think 6.2 is more likely in FY26.
What do you think is going to be the commentary on liquidity, and how do you think the central bank is going to enable, liquidity is a flush with banks and faster transmission, of course?
I think from the RBI's standpoint, they have done a great job in infusing liquidity in the last few months. And for now, it does seem like they have done enough. And so we don't think there will be any further action today. However, the communication on liquidity will still be important, and re-emphasizing and reiterating what was stated the last time, which is that the RBI will keep banking system liquidity in a surplus of around 1% of NDTL. I think that communication should still come through. Now, we know that the actual transmission from liquidity to bank funding costs coming down to that leading to lower lending rates typically takes time. And so the transmission process has started, it will continue. Meanwhile, it's just important from the central bank's perspective to retain and communicate on liquidity staying in a surplus. I think the rest will happen over a period of time.
That's Sonal, give us some sense that how do you see the whole capex numbers going ahead? Because for now, post the budget as well, we have seen the government spending holding up. But what's your sense for the second half of this fiscal, and along with that, how can we expect to see the private participation?
Our baseline view is the public capex side will remain strong, and whatever the government has budgeted, that will get executed. Of course, what we've seen so far in April has been a fairly sharp jump in central government capex. It was up over 60% on a year-over-year basis in April. So there is some sort of front loading of capex we are seeing, which makes sense. So that we think will continue. On the private side, things are a bit more complex. Capacity utilization is still in the mid-70s. And we've seen a rush of imports from China, which could partly be a reason why capacity utilization is low and uncertainty is high. So typically, it's not a macro environment where we see new machinery and equipment capex happen. So we think, it's going to be more public capex driven, and private is likely to remain soft in FY26.
Sonal, before we let you go, just want to get your sense on where the RBI is seeing our GDP headed, because if RBI is likely to retain their FY25 GDP predictions, then why are on one hand they increasing their own estimate going ahead for the GDP? So help us understand what's happening on this front.
So we are expecting the RBI to retain its estimate of 6.5, not expecting them to change that. And I think what we will be looking for is really the commentary in terms of the drivers of this growth. So to what extent domestic demand can offset the expected moderation on the exports and the external side, given uncertainty is quite high there. I think other than that, I think the important question is around 6.5% enough relative to what our longer term potential and aspiration is with respect to creating more jobs. And I think that has been a big focus. And it does appear, looking at the whole set of macro data, including things like, very benign core inflation, that the actual growth right now is below what our potential is. So the numbers are good, but in terms of the breadth of the growth recovery, it's not where we want it to be.
Sonal, that's precisely what I meant to ask you, because if you believe that the underlying growth is still below our potential, then what would be the reason behind you increasing your GDP estimate to 6.2% from 5.8 earlier?
Yeah, the fourth quarter numbers were much better than expected at 7. So fourth quarter FY25 at 7.4%. I mean, it was driven by a few technical factors, which we can go into if you like. But the starting point was much better than expected. And the lower inflation, so for FY26, we're expecting average CPI inflation at 3.3%. So significantly below the 4% target. Now, low inflation also tends to be a tailwind for India. particularly for from a private consumption side, real disposable incomes go up when inflation goes down. So that's a positive that we have incorporated. And third, I think amongst the various nations that are trying to strike a deal with the US, we do think India is one of the front runners. So while the global environment is fairly adverse, India can relatively do well in some of the low-end to mid-tech manufacturing segments and get some market share. So we've incorporated these things in our new forecast.
Sonal, great having you on the show today. Thank you so much for your time. Okay, that's the word coming in on the state of the Indian economy with Sonal Varma from Nomura. But let's shift back to what's happening.
If you like this video, then like, share and subscribe to ET Now.